How and when do stock markets crash? After the huge 35% stock market crash of COVID, a topic that has got many interested and worried is about stock market crashes. Most of us have lived through at least two crashes, the other being the 2008 financial crisis. But this interest is not only because of curiosity, but also to protect oneself from these crashes. In this video, we take a look at when does a stock market crash and how to protect yourself from one. Keep watching to find out. What is a stock market crash? A stock market crash refers to a rapid fall in the country's stock market index in a single day or over a few days. There is, however, no specific number that can describe a stock market crash, but is generally called a crash when the index like Nifty or Sensex falls by a double-digit percentage in a short period of time. This, however, should not be confused with a stock market correction. This is because the stock market crash is a lot more quick. Another term that some may confuse a stock market crash with is a bear market. A stock market crash may bring forward a bearish market, but the two are different. A crash, as mentioned earlier, happens in a matter of days or weeks. A bearish market, on the other hand, remains over months or even years. In a bear market, the stock market falls by at least 20% from its peak over a period of time. Another follow-up characteristic of a stock market crash is that investors enter a state of panic and look to sell their stocks as soon as possible. This is done in order to avoid further losses, but this only further hammers the market down. Some examples of stock market crashes in the Indian stock market are during COVID-19, the 2008 financial crisis, and post the Harshad Mehta scam. As seen in these cases, the stock market crashes also have severe consequences on the country's economy. What are the causes of a stock market crash? And when does a stock market crash happen? Stock market crashes are generally triggered by negative events that may affect the economy. These are generally amplified when the market has experienced a bull market for a prolonged period of time. This leads to investors selling off their investments. Now let us take a look at some of the negative events that might trigger a crash as such. Number 1. Natural calamities. These are the reasons why crashes are known to be unpredictable. These can include earthquakes, tsunamis, etc. that have a widespread impact on the country's economy. One of the most recent effects and the best example of a stock market crash in this case is the COVID-19 pandemic. The fear of the effect that the pandemic will have on the country's economy led to the stock market falling by over 30%. Natural calamities, however, are not the only cause. There also exists a number of unforeseen man-made events that may cause a stock market crash. Economists and unbiased seasoned investors generally see signs of this coming from miles away. One of the best examples of this is the American mortgage crisis of 2008. The ailing banking sector finally gave in, leading to the stock market crash of 2008. Number 3. Speculation and panic selling. Generally, in long periods of bullish markets, a lot of trades are done on speculation. Investors generally have high expectations from the market as they have observed the bullish market from a period of time. But pumping money into the market based on these expectations leads to an overinflated price scenario called a bubble. Over time, the market generally fails to meet the high expectation of these investors. This in turn leads finally to the bubble being burst. This in turn leads to panic selling in a desperate move by the investors to protect their investments. This further worsens the scenario leading to a crash. How can one identify a stock market crash? One of the best quotes that individuals can refer to in times of doubt is given by Joseph Kennedy. If shoeshine boys are giving stock tips, then it's time to get out of the market. As the story goes, at a time when the American markets were at an all-time high, the stock market craze had caught on to most individuals. As Kennedy stopped to get his shoe shined, even the shoeshine boy started giving him stock tips. This was when he realized the quality of knowledge within which investing was done and funds that were being pumped into the stock market. This allowed him to realize that the stock market had entered a bubble. Generally, when one hears an urgency to invest in the stock right now or miss out on a big opportunity, it is time to take a deep breath. It is here when the markets are driven by emotion rather than a deep analysis of the financials. If your investments are made based on the latter, for long term, then there is very little that you need to worry about. What should you do to protect yourself before and during a stock market crash? As we have seen above, there are no concrete steps an individual investor can take to identify stock market crashes. Individuals cannot predict calamities, but at times they can identify bubbles or when the economy is particularly performing poorly. But the stock market is still bullish. Regardless, here are some steps that individuals can take to best protect their investments. Do not give in to the pressure to sell, instead buy if possible. Generally, in case of stock market crashes, investors enter into a state of panic. Here, they begin selling their holdings in an attempt to protect themselves from further losses, but often do so at a great loss already. One aspect of the stock market crash is that investors must keep in mind the markets rebound back to their original state in a matter of time. So if an investor has already invested in quality stocks after analysis for the long term, he should stay put and not follow the crowd. Take for example an investor who entered the market at a share price of Rs 80. His investments touch a height of Rs 100. During a crash, his investment might fall to Rs 60. But by following the crowd, the investor might incur a loss of 25% or even worse. Staying put and believing in his research is the best strategy in this period. A famous investing quote by Baron Rothschild goes, "The time to buy is when there's blood on the streets." In this case, it means that during a stock market crash, when most investors are selling, one must look for opportunities. Several quality stocks are available at highly discounted rates. Hence, one must take advantage of this scenario while others panic and take on losses. Number 2, have a diversified portfolio and rebalance to suit the market. It is always advisable to have a diversified portfolio, but this diversification should not stop at stocks. Investors must also make use of all instruments like bonds, gold, silver, etc. to further protect themselves. This will further help reduce the impact of an investor while facing a crash. Also, it is important that the investor adapts to the needs of the market. It is generally noticed that price of gold increases when the stock market performs poorly. Taking note of this, it is best to go ahead and rebalance your portfolio as per the situation. Number 3, always have a safety nest. It goes without saying that never put 100% of your savings into the stock market. It is important to always have a nest put away in other means like liquid cash, land, etc. Protect yourself on a rainy day. At the end of the day, it is important to remember the saying that has already been drilled into our heads: stock market investments are subjected to market. In closing, at the end of the day, no one can perfectly predict each and every stock market crash. There is one instance where it clearly helps to stay calm or just be a long-term investor. If you are one with quality researched investments, you have little to worry about. Although you will feel the pinch of the fall in your portfolio, the markets are known to rebound in a matter of time, often to new heights. That's all for this video. If you enjoyed the video, please hit the like button and subscribe to our channel for more interesting stock market videos. Take care and happy investing.